where we are at the moment in terms of your business and what's been happening on the markets and the prism with which you're looking at this pandemic, as perhaps we see signs of lockdowns easing in parts of the world and some being reinstated?
Absolutely. Well, thank you so much for having me. You know, I think so much has changed in the last several months, but we're at a very interesting juncture. We see our clients in asset management starting to shift from the immediate challenges of negotiating this crisis to really saying, what are the long-term perspectives I need to think about for my asset allocation and my portfolios? What trends will be sticky from these events? I think work from home, changes to the healthcare process around the world and the healthcare industry, obviously the adoption of new technologies. These are some of the trends that will be sticky over time and that clients are trying to make sure are captured within their portfolios.
Sheila, the other thing that's been happening in your business, of course, has been taking control of your securities JV. Do you see that as a further move into China and also perhaps deepening your commitment to China? And doesn't the way that Beijing and Beijing and Washington at the moment argue with each other worry you?
Well, you know, we've been involved at Goldman Sachs in China for many, many decades, including, you know, the Hank Paulson era and beyond. And to us, this just represents our commitment to our clients in the region and to global markets. From our perspective, obviously, the U.S.-China tensions are very worrying. I think most clients I talk to globally, though, expect that's just a paradigm we should be living in for quite a while. Two economic superpowers, two countries with quite a bit going on now with this crisis and this pandemic, and two different viewpoints from time to time, yet, you know, very interdependent as well. So from our perspective, while challenging, there's still a lot to be done both in the U.S. and in China and in their relationship.
Sheila, hasn't it baffled you that, you know, you've seen these rallies, sometimes at all-time highs for these equity markets, at the same time that we've got a global pandemic, got civil unrest, mass unemployment, a recession, some would argue even a depression here. Hasn't it left you scratching your head?
You know, I think it's both a head-scratcher and then there's some underlying trends that do explain a bit of what's gone on. If you look at the real move in the markets we had several weeks ago and how most large global institutions came into that market, really many had raised cash at the end of last year. There were expectations of a recession, although certainly not for this reason. And so many people were conservatively positioned. When you got a really extreme decline in the markets, therefore, they saw an opportunity and they looked back at their experience in 08-09 and said, I see it again. I would like to buy equities, just straight out, increase my position, use some of the cash, not all of it. Today, as we continue to see the rally extend and we see these fits and starts, you have a lot more participants than in those early days. We've seen the trends show, and some of the mutual fund and other data shows that retail has gotten heavily involved globally as well. They've been buyers, whether in the ETF markets or the mutual funds, and in general, again, beefing up their portfolios, seeing these levels as a long-term attractive buy. We expect more volatility, so I wouldn't go all eggs in one basket, but those are some of the reasonings.
Sheila, you touched on the U.S.-China tensions. I mean, especially with the elections coming, well, inching as November comes. I mean, how do you rate the risk from that? And do you see bilateral issues spilling over to broader assets at some point?
Yeah, look, I think we see these tensions continuing. And in fact, you know, I was talking to a global group of clients on Friday, U.S., Canadian pensions, a number of sovereign wealth funds here in the Asia region. And they're game playing and expecting tensions to just continue for 5 to 10 years. So what does that mean and what markets do they affect, right? If it continues to be various skirmishes on the trade front, it has some impact sector by sector, but overall, it still preserves some amount of commercial interaction, a significant amount between the two countries and from a global perspective. If you get to a deeper level of crisis, if that's precipitated by political events or other issues, then they start to worry quite a bit more. And I think the global nature of investment itself is something we have to keep on the radar, whether it's regulation in the US or in China or elsewhere. Many people are also concerned about whether the investments they've made over several years in the past become more restricted in future. Do they get their money? Everybody worries about that question.
And of course, as you look for opportunities, do you see opportunities in the Greater Bay Area?
Yeah, look, as we look at the opportunity set, again, I think we're very much driven by the question of what is the post-COVID economy, what is the resilience economy, and I think that's really where we're headed. What companies have diverse supply chains that obviously, could have some negative impacts on China as people diversify away from having, again, all their eggs in one basket, but certainly is not solely based on that framework. I think we see advances in adoption of technology that will be sticky, and some of those are coming out of the greater region. And we also see that many trends we had invested in thinking they were important for millennials, such as some of the trends that have been happening in healthcare and in using online shopping, et cetera, have now extended to all generations. Many of those technologies and those initiatives are coming again from this region. So that's an advantage too.
And Sheila, in just a span of just a couple of weeks, social responsibility has come to the forefront for investment conversations, everything from health, race, gender, income inequality. How are these social issues influencing investment strategies, you think?
Well, it's fascinating. As you came into the crisis, I had many people ask me, will ESG just get thrown aside as people worry about just the basic impact of this crisis, their portfolios, the sharp moves in the markets? In fact, where we've ended up is ESG has become more central than ever. And whether people continue to worry about governance and questions around supply chains, cash on hand, et cetera, very much go to the question of management. Whether it's environmental, this is a zoonotic disease and more evidence of the fact that man and nature intersect in some kinds negative ways, and how does that need to be managed? And then lastly, and probably most prominently in the crisis, the S, the question of social responsibility. And we see companies being held by their investors to standards of how they treat every stakeholder group, employees. How do they deal with work from home? How do they deal with healthcare, both physical and mental? How are they interacting with their governments and communities? Are they taking funds? And if so, what are they doing with those governmental funds? So previously, people maybe had difficulty defining the S. Today, it seems a lot clearer. And whether it's those big institutions or retail, where we've seen a huge appetite for ESG during this crisis as well, with boomer demand for mutual funds related to ESG up over 100%, I think this is a trend that's here to stay, and really more than a trend. It's just endemic in the way people want to invest.